Hello, good day. I hope you are fine. I have not seen you for a while. This video focuses on the valuation of merger and acquisition. What will happen to the share price after the merger? Which stock will change in value? How to perform the evaluation? What is the acquisition price that is fair to both parties? These are interesting and important questions that investors always like to ask. In this video, I'm going to use examples to explain the merger valuation process. In particular, I use the examples from two major textbooks by Hillier, here's the book, and Gigman, here's the book. Hillier's book is the prescribed textbook for our course, and I find that the stock swap transaction explanation in Gigman's book is very clear and simple to understand. I have modified the example slightly to incorporate some of my teaching experience. The credits belongs to the authors. I strongly encourage you to refer to these two textbooks. At the end of this learning session, it is hoped that students will be able to perform valuation on a merger or acquisition and discuss the effect on earning per share and share price. Stay tuned and let's learn together. When considering a potential target for acquisition or merger, the acquiring firm should take the following four steps to evaluate prospective targets. The first stage in the valuation process is to consider the target as a stand-alone entity. To value a company requires the estimation of future cash flows and the appropriate discount rates. The initial valuation should then be compared to the current share price of the target to form an initial opinion of the merger. Stage 2 involves calibration of the valuation. It is very unlikely that the initial valuation of the target firm will be equal to its share price. Any differential in valuations need to be reconciled. Stage 3 concerns with the valuation of the benefits or synergies of a possible merger or acquisition. Synergy is evaluated by estimating the cash flows generated from the merger, discounted at an appropriate discount rate. The final part of the analysis is to value the merger. It is important to compare the valuation of the target to the value of the synergies from the merger or acquisition. The rule of thumb is that the merger or acquisition should go ahead if the cost of the merger, which includes the bid premium as well as all transaction costs, are lower than the combined value of the merger. In the first section, we are going to learn about the NPV of merger. What is the common method for merger valuation? Firms typically use net present value analysis when making acquisitions. The payments to acquire the target firm can be made by cash or equity. The analysis is relatively straightforward when the consideration is cash. The analysis becomes more complex when the consideration is equity. We shall learn more in the next few slides using an example. Stay tuned. Over the years in my teaching, I have compiled and summarized a list of formulas that might be useful for students if they like to use formula as reference. However, I strongly believe that even without this list of formula, students should be able to perform valuation based on logic and understanding of the basic concepts. So, not to worry if you cannot remember the formula. In this list, there are a wide range of formula to calculate value of firm, net present value, premium, and synergy. We shall look into an example on cash acquisition. Firm A plans to acquire Firm B in cash. The background of both companies before the acquisition is summarized in the table. Analyze the information given, the combined value after merger, and the offer price. Should Firm A acquire Firm B? We shall explore further. A good way to conduct a complete analysis is to calculate the following 7 items after the cash acquisition. I have listed the final answer at the end of the slide. I hope you will pause the video and try on your own first. Let's look into the calculation. Question 1. Calculate the number of shares in Firm A after the cash acquisition. The number of shares in Firm A remains the same as 25, as the acquisition is paid with cash. No new shares are issued. Question 2. Calculate the value of the acquirer after the cash acquisition. The value of the acquirer is the value of the combined firm after the merger minus the cash paid, because the asset in the combined firm is reduced by the amount of cash paid out. Question 3. Calculate the share price of Firm A after the acquisition. The share price of Firm A, the acquirer, after the merger is 550 divided by 25 and equal to 22. Question 4. Calculate the cost of acquisition. The cost of acquisition is equal to the cash offer price. Question 5. Calculate the NPV of merger to Firm A. The NPV of merger to Firm A can be calculated in 2 ways. First, we can compare the change in value of Firm A before and after the acquisition. Second, we can use synergy minus the premium paid to calculate the NPV of merger to Firm A. Question 6. Calculate the premium. Premium measures how far the cash price is above the value of the target firm, which is 150 minus 100. And lastly, calculate the synergy. Synergy is derived from the benefits of merger. Synergy represents how far the combined firm will increase in value as compared to the sum of the individual firms. This slide summarizes the overall position of Firm A and B before and after the cash acquisition. To conclude, Firm A should make the acquisition, as there is a rise in equity price. Firm A derives synergies from merger. Next, we shall look into an example on equity acquisition. The background of the companies involved are the same as our previous example. Firm A plans to acquire Firm B with equity instead of cash. Firm A exchanges 7.5 of its shares for 10 shares of Firm B. This means the exchange ratio is 0.75 to 1. Should Firm A acquire Firm B? We shall explore further. Again, we are going to calculate the following 7 items after the equity acquisition. This allows us to conduct a complete analysis. Again, I have listed the final answer at the end of the slide. I hope you will pause the video and try on your own first. Let's look into the calculation. First, we are going to calculate number of shares in firm A. The number of shares in firm A increases. The total shares will be existing shares of 20 plus new shares issued to shareholders of firm B. Second, calculate the value of the acquirer. The value of the acquirer is the value of the combined firm after the merger. There is no cash payout in this case. Question 3. Calculate the share price of firm A after the equity acquisition. The share price of firm A, the acquirer, after the merger is 700 divided by 32.5 shares and equal to 21.54. The share price of firm A increases after the merger. Question 4. Calculate the cost of acquisition. The cost of acquisition is equal to the new share price times number of shares issued to shareholder of firm B. Question 5. Calculate the NPV of merger to firm A. The NPV of merger to firm A can be calculated in two ways. First, we can compare the change in the value of firm A before and after the acquisition and minus the cost of acquisition. Second, we can use synergy minus the premium paid. Next, calculate the premium. Premium measures how far the purchase price is above the value of the target firm, which is 161.54 minus 100. And finally, calculate the synergy. Synergy is derived from the benefits of merger. Synergy represents how far the combined firm will increase in value as compared to the sum of the individual firms. This slide summarizes the position of firm A and firm B before and after the equity acquisition. If you compare the equity acquisition with the cash acquisition, you will find that the cost of acquisition is higher in the equity acquisition. The share price of firm A is lower after the equity acquisition due to higher premium paid. Normally, the shareholders of the target firm would require a higher premium if the acquisition is paid by equity. Now we are going into the second section on stock swap transaction. In the second section of this video, we are going to look into an interesting and important question. Which party will benefit from a merger, the acquirer, or the target firm? Stay tuned. The use of stock swaps to finance mergers is a popular approach. What is a stock swap transaction? Stock swap transaction is an acquisition method in which the acquiring firm exchanges its shares for shares of the target company according to a predetermined ratio. This means the acquisition is paid for using an exchange of common stock. The ratio of exchange of shares is determined in the merger negotiation. Next, read this slide. I'm going to ask you 3 questions. What is the important criteria for the acquiring firm to complete a stock swap transaction? What needs to be done by the acquiring firm before the stock swap transaction? Should the acquiring firm pay above or below the target firm's current market price? I'm sure you can derive the answer from the slide. It is also important to understand the concept of ratio of exchange. By definition, the actual ratio of exchange is merely the ratio of the amount paid per share of the target company to the market price per share of the acquiring firm. Well, to remember this formula easily, you can imagine the price of purchase is paid by the value of the acquiring firm. Ratio of exchange of 1 means one acquiring firm share is exchanged for each target firm's share. Let's look into an example on stock swap transaction. Read this example. Which company is the acquiring firm? Which company is the target firm? Well, a very important first step in merger announcement is to identify the acquiring firm and the target firm. In this case, Grand Company is acquiring small company. Calculate the ratio of exchange. The ratio of exchange is 110 divided by 80 and is equal to 1.375. This means that Grand must exchange 1.375 shares of its stock for each share of small stock. This slide shows the financial data of both companies before the merger. At a glance, Grand has higher earnings and market capitalization as compared to Small. A complete analysis of the stock swap transaction involves the following calculations. I have listed 6 questions here. Please try on your own first. I have put a little answer at the end of the slide to encourage you to try. Happy trying! Let's look into the calculation. Question 1. The number of shares issued to complete the merger is equal to the number of existing small shares times the ratio of exchange. Question 2. The number of Grand shares after the merger is the existing number of Grand shares, 125,000, plus the number of new shares issued to small shareholders for the acquisition. Question 3. The earning per share of Grand after the merger is the combined earnings of both companies divided by the number of Grand shares outstanding after the merger. Question 4. The earning per share of Small after the merger is the Grand earning per share multiplied by 1.375. This is because each existing small share is converted into 1.375 Grand shares. The P/E ratio of Grand is expected to be 21 times after the merger. Therefore, in question 5, the market price of Grand will be the expected P/E ratio, 21 times, multiplied by the earning per share of Grand after the merger. And finally, question 6. The P/E paid to acquire Small is the offer price divided by the earning per share of Small. Let's conclude our findings. Do you notice that the earning per share of the original Grand and Small shares changed after the merger? Why do the earning per share of Grand shares decrease? Why do the earning per share of Small shares increase? Well, it has something to do with the acquisition cost. A good measure is to analyze the P/E ratio paid to acquire Small. If the P/E ratio paid to acquire Small is greater than the P/E ratio of Grand, the merger will cause the earning per share of Grand to fall. On the other hand, the earning per share of Small will rise. This table provides a good reference for the effect of PE ratios on earning per share. If the PE paid is too high, higher than the PE of the acquiring company, it will be a disadvantage for the acquiring company. Therefore, the EPS of the acquiring firm will decrease. Since the target firm managed to sell off at high price, the EPS of the target firm will increase. In contrast, if the PE paid is lower than the PE of the acquiring company, it will be an advantage for the acquiring company. Therefore, the EPS of the acquiring firm will increase. A good balancing point for the merger negotiation for the acquiring firm is to bargain at a purchase price where the PE paid is close to the PE of the acquiring company. Next, we are going to explore an important question. What is the impact of the stock swap transaction on the market price? We have calculated the value of Grand shares based on 21 times expected PE ratio after the merger. To add on to that, it is worth noting that the market price per share does not necessarily remain constant after the acquisition of one firm by another. Market price will depend on how investors evaluate the future prospect of the merger. Adjustments in the market price occur in response to changes in expected earnings, the dilution of ownership, changes in risk, and certain other operating and financial changes. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.